Very good morning to everyone. This is Magdalene from Itus Capital. I'd firstly like to wish you all a blessed and beautiful 2022 and welcome you all to our Itus Annual Investor Call 2021. At this time, I'd like to thank everyone for taking the time out to be a part of the call. These are tough times and I hope you all are safe and doing well. Before we move into the major part of the call where Naveen would walk us through the Q2 earnings of 2021, I'd like to keep all the participants informed that all the participants will be in a listen-only mode. And after a presentation by our founder and fund manager, Naveen Chandramohan, we will have a session for Q&A. From here on, I would request Naveen to take over and do us a presentation.
Thanks, Magdalene, for this kind introduction, and appreciate everyone for taking the time out to do this. As Magdalene mentioned, I can't thank you again for taking the time out. And I really hope that you and your family and your loved ones are doing okay. These are not easy times, but I'm confident that this too shall pass. The last quarter was a very interesting one. When I say last quarter, I'm talking about the September ending quarter because the December ending earnings season is going to start shortly. Why was it interesting? Because there were businesses that were relatively unaffected by margin pressures that came about due to raw material cost increases, or there were businesses that happened to be in our portfolio despite all of this, which were gaining market share. So in this presentation, we will walk you through first our performance, review the year that just went behind, our learnings in the year. We'll look forward into how is our positioning for the next, I would say, 3 to 5 years. What do we expect from the fund over the same period? And then, like Magdalene mentioned, talk you through as well as answer any questions that you may have. So, like I always do, it's just a good housekeeping practice to look at how did we end the previous quarter call, right? So we've spoken about a few trends that were developing in the market. One was the domestic positioning alongside retail participation, which in effect is actually good for the markets from a long-term perspective. More importantly, we'd ended the call last quarter with an expectation from the investor around what they should look at from an equity market perspective. Because from a short term, it looked like there was a lot of trading oriented mindset into the markets. Some part of it was corrected, some part of it is still not. And end of the day, from a longer term perspective, we were extremely optimistic around where India was and how the earnings trend was going, especially around how our portfolio was positioned. Looking back, right, how did we end the calendar year 2021? So we obviously ended on a strong note with the fund up close to 30% in the year post fees. So this puts our absolute performance since inception of the fund at a cumulative 205%, as against Nifty at 111%. So what this means was an absolute outperformance of close to 93%. And from an IRR perspective, beating the index by a close to 9% IRR. Right. This was always the endeavor for the fund when this was set up in 2017. And I believe our process of investing and focusing on cash flow growth oriented companies will ensure a similar, if not a better consistency as we go ahead into the next 5 years as well. Reason I talk about 5 years is I think every investor and fund manager will at least see one down cycle. And it's important to see these down cycles over and over again in order to show consistency in terms of what you aspire to do from a returns perspective. What does this mean from the money that an investor had put in on day one? 1 rupee would roughly be worth 3.05 today. And from an IRR perspective, cumulatively, when I spoke to you about the returns, from an IRR perspective, the fund has compounded at 25% net of fees. Which is what I told you, that we want to be continuing to beat the Nifty, which is the index of comparison, by around 6 to 7%. Why do we aspire to do that? And why do we think we can continue doing that? I'll talk you through that in the next few slides. So an important thing to realize about Itus is we are not the fund that one looks at to keep generating monthly returns or quarterly returns, right? So if someone is looking for that, this is not the place, right? From our perspective, what is consistency? Consistency is where during down cycles, which you're going to see many, right? How do you protect the value and ensure that there is no panic from an investor psyche perspective? So if you look at how we've done during up markets and down markets, right? So from an up market perspective, where we have seen roughly around in the last 5 years, which is around 20 quarters, 15 quarters up market, right? We've beaten around in these up markets, we've beaten the index by around 65% of the time, and our average alpha during these up markets is 1.19%. In the down markets, where we've seen 5 quarters of negative returns, right? Our average alpha has been 4.02%. So what I'm trying to tell you is, while we have done an IRR outperformance of 9%, most of it has come by outperforming on the downside, rather than saying I'm going to go all in on risk on the upside, because I don't know when a bull market is starting and when it is ending. All I'm in control of is the performance during the philosophy that we follow, right? So it's really important to understand this, because we all like bull markets, and pretty much everyone is aware that over the next 10 years, India should do well. We are primed to do well. And that is a constant theme that's going to emanate. The reason I talk to you about down markets is because I want to take a step back in history and just remind investors what is a bull market, right? See, US went through a decade of outperformance, and this is which was between 2010 and 2021, right? This is the longest bull market US has ever seen in the last 40 years. And I need to put this into context. This is the longest bull market US has ever seen in the last 40 years, right? And within this bull market of 10 years that we are talking about, US indices, right? I'm not talking about stocks, because stocks are going to be a lot more volatile than the index. US indices fell 20% or more 5 times, right? So what I'm trying to remind you is, while I'm going to tell you that we are optimistic and why we are optimistic, it doesn't mean that we are not going to go through volatility, right? So it's not like everything is hunky-dory, the returns are going to be smooth. And while you want to be participating in the entire India growth story, which we are in the middle of, it's important to ensure through that growth story, your capital appreciates because you manage your volatility during downside. And that's the reason I wanted to emphasize this slide. It's important to also say, okay, it's good that we've compounded at 25%. It's good that we're optimistic in the future, but why do we do this, right? What is the characteristic of the portfolio that ensures our performance? And why do I always say our process is revolved around cash flow growth, come what may? There could be a thesis in the market saying I'll invest in cyclicals or I'll invest in metals. That doesn't appeal to us. It's not something that we would do. It's not something we're comfortable doing. Why? Because we don't see consistency in cash flow growth. So what we have done here in this slide is to take some of the top 6 exposures of the company. Godrej Properties was a portfolio company in 2017. It's not today. It's an exit. Give you a sense of what our holding period has been in each of the 5 companies that I spoke to you about, Godrej Properties being the 6th one, which has seen an exit. Give you a sense of the short-term cash flow growth, and give you a sense of the holding period cash flow growth. I'll give you an example. So let's take one of our portfolio companies, which is doing well. And we've received many questions in the last few months from our investors saying, why are you not exiting when the company has done so well for you in such a short time? And I'll explain why we are not exiting this and how we think about an exit also through the process, right? So let's take L&T Technology Services. We've held this for the last 1.5 years. And I don't foresee anything changing in the short term over the next 1-2 years either. When I say short term, I'm thinking about 4 to 8 quarters. When I say long term, I'm thinking about 3 to 5 years, right? So over the last 1.5 years, the cash flow growth of this company has been 84%. When I say cash flow growth, I'm not talking about earnings growth. There's a big difference between earnings growth and cash flow growth. Not All companies, in fact, in India, it's only 5% of the companies, as hard as it may sound, that can translate earnings growth into cash flow growth, right? So while earnings growth is great, that's not what we care about. We look at it, but how many of these companies can translate earnings growth into cash flow growth? And why does it matter? Because if you are running your business, earnings growth is not the raw material that you can reinvest into the business. It's the actual cash that your business generates that you can reinvest into the business. If I have earnings growth that I can't translate into cash and I want to grow my business, then I have to borrow. And that's when balance sheets get inflated. And those are the companies we don't like. It might show you great earnings growth, but if it doesn't show you cash flow growth, there could be inherently a problem during a down cycle, right? So coming back to L&T Technology Services, while the cash flow growth has grown by 84%, what has the returns done? 88%. So what I'm basically trying to tell you is the fundamental returns that are coming through is because of cash flows actually growing. These are companies you want to be holding. You don't want to be selling out just because you're making money, right? This is not a stock or a piece of paper. This is a business that you're talking about. In the last 1 year, cash flow growth has been 107%. Right? So you have a typical compounding machine. Does it mean it can do this over the next 7 years? Those are trends that you need to monitor, right? I'm not saying it will do this over the next 7-10 years. Those are things that you keep monitoring to see, are there tailwinds behind the business? Is the order book good? Is the management reinvesting it properly? But at a fundamental level, if you look at all of the large portfolio sized companies that we own, their cash flow growth as well as the returns that they have generated during the time that we have held this will more or less match. And it coming back to why I mentioned Godrej Properties, right? Which I've always told investors, and if some of them are new on the call, and I continue to reiterate, we are not a buy, hold, and forget investor. We will exit when there is a disparity between cash flow growth and the returns that the market gives us. And that's the ideal example I wanted to highlight was Godrej Properties. This was an investment we did back in 2017. If you remember, that was a period that we went, as a country, we went through an era and demon and closed times. So most of the real estate companies took a big hit. We wanted to invest in the best brand, which is still continuing to grow its cash flows. Over the 5 quarters that we held the stock, right, the cash flow growth was around 45%, which was not bad during some of the worst times that real estate stocks went through at that point of time. But look at the returns, 200+%. When this kind of disparity happens, there's an opportunity cost in our portfolio. And that's the significance of running only one portfolio, because every investment that you have in the portfolio has an opportunity cost because you're running finite capital. Right? You don't have unlimited capital, and neither do you have the ability to rotate investments between one portfolio and portfolio B and portfolio C that you're running, right? There's only one portfolio. So at that point of time, you have to take a call as a fund manager saying that, are there better investments which are actually growing, which have an opportunity cost lesser than what you actually own? And that's the reason for the exit, right? So the reason this slide is important to explain to you is when I tell you the cash flow growth of Itus has compounded at 40% in the last 2 years. What does it even mean, right? And why are we optimistic over the next 3-5 year cycle that these companies are going to give a similar compounding? Because the cash flow growth is there, right? What happened in the last 5 years, you can break it down through data, but an investor looking at us today should get comfort around the process and why this is a repeatable process, and this should continue in the future, irrespective of down cycles or up cycles, right? So it's important I wanted to spend some time on this. Moving on to our actual portfolio, right? So over the last quarter at least, so if you've been attending our calls, I break down every quarter what kind of activity happens in the portfolio. Our activity is generally low. We are not a high churn portfolio, but it doesn't mean that there will not be churn. So there was a sale of one of the portfolio companies that we owned. It did reasonably okay for us since inception, compounding at almost 64% IRR during the time that we held it. But we in the last 1 year, it was a big underperformer. But that's not the reason we sold it. I'll cover and walk you through why we sold it. And we also had a few recent buys, which I'll walk you through. So this chart walks you through the daily AUM up to Jan 22, right? So how do we monitor this? I spoke about this in our annual letter. We have technology from a product perspective that we've built, which gives us access to this to the click of a button, right? So what happened in the last 1 year or 1.5 years? 5% CAGR growth in AM, one of the slowest in the industry, but that's not the reason we sold it. The most important part of HDFC AMC, whether we like it or not, at least the thesis for at Itus was around the flagship fund, which is managed by Prashant Jain. And at Itus, we have a constant belief that the focus on the flagship fund has been reducing over time. Right or wrong, time will say, but the new CEO who's come in has been focusing on expanding the product portfolio through ETFs, where they have been a laggard over the last 3-4 years. ETFs are a good asset class because they are giving you top line growth. From a bottom line growth perspective, it will always be a lower margin product than many of the actively managed funds. As the competition is increasing in this space, they are now focusing on alternates. This is their second foray into alternates. If you study the history of HDFC AMC, they went into alternates in 2010. It was not a good experience. It was not something the old CIO was something that he was comfortable with. So there are a few changes happening within the AMC, both in terms of a product positioning perspective, in terms of how the new CEO wants to expand the business, where we feel that from a cash flow growth or from a PAT growth perspective, because AMCs have huge operational leverage, we don't feel comfortable that the growth is going to be what we expected it to be. And we feel that because of the same opportunity cost, we rather exit and reinvest it into better companies. So in a nutshell, that was the primary reason for us to exit. Next, I'll talk you through the 2 buys that we did. Bata. So just to give you a background, spend some time, because the first time that we are covering this company through our investors. So obviously there are 3 large brands. All 3 are listed today, Metro being the most recent IPO in the footwear market. Bata has always been in the middle range in terms of where it's positioned itself as a brand, right? And between March 2010 and 2020, right, the company actually gave a fairly significant shareholder return. And again, this goes to reiterate earnings growth versus cash flow growth. 33.4% shareholder return over the decade, right? It's actually one of the better shareholder return companies in a decade where most companies saw poor growth. Now, look at the top line growth of this company. 2x over the last 10 years, which is sub 10%, right? So one might wonder how can a company give you 33% shareholder return when the revenue growth is less than 10%? It is because this is a cash flow generating machine. The issue for the company was always, it was not reinvesting this cash flows well, right? So what actually happened, if you look at the balance sheet back in March 2010, the cash in the books was around 100 crores. Today, or rather, as it went through the first lockdown in March 2020, the cash in the books was almost 1,100 crores. Now, looking back with the benefit of hindsight, that's exactly the reason they were able to navigate COVID unscathed without taking on any debt. Because when the revenue is almost half, because it was not an online presence brand. Today, almost 8% of the sales comes from the e-commerce, because that was the transition that they made, right? So not having any debt on the book actually helped them navigate COVID relatively unscathed, right? So effectively, 2 things has happened in the last 1.5 years. First is there have been multiple management changes, with the new India CEO having more of a marketing, distribution, and franchise background. And that is something that Bata should evolve into as they scale. So the reinvestment of cash from the balance sheet, we expect this to actually expand into the franchise model as they scale. Second place of reinvestment is aggressive investment into e-commerce. It's translating into slower growth today. It was almost negligent 2 years back. Today it's at 8% of sales, and we expect that to increase. Right? Net with all of this, you're dealing with a very interesting company which has been a cash generating machine, clean debt, no debt, clean balance sheet. management change resulting in a much better product positioning, as a result of which we think the compounding effect should take into place. Now, effectively, this slide just tells you their focus around where they are going, where the number of store counts, which is their own store counts, dropping and moving into a franchise-based model, which is what I spoke to you about. The second company that I wanted to cover in slightly detailed length is Nykaa. Okay? Obviously, Nykaa was one of the most talked about IPOs for a reason that pretty much everyone knows. Right? It's important to understand where Nykaa has positioned within the Indian ecosystem. So, beauty and products, BPC as a category, as they call it, is a very interesting category if you study the history and evolution. And to history and evolution, you have to go back into similar trends that have happened outside India as well. So there is a large brand called Sephora, which built a very similar platform, which is now no longer under Sephora. It is owned by a company called LVMH. Louis Vuitton owns Sephora today. Right? So Nike's evolution happened on the back of how Sephora evolved. And the category evolved around the fact of very, very similar dynamics. There was a supply side problem and there was a demand side problem, which was India specific. The supply side problem existed around the fact that the end consumer wanted to buy brands, but the number of fakes that existed in this category was its highest. There is no single category in India where these kind of fakes exist. Maybe in liquor and cigarettes there are, right? But apart from that, these kind of fakes in the market, there is no single category that exists. So there was a big problem on the supply side. On the demand side, penetration was not there, right? So when I talk you through some of the penetration numbers, you will understand what I mean when I say penetration is not there. So for us, there are two ways that we look at monitoring Nykaa, at least at Itus, right? One is a bottom-up way, another is a top-down way. The top-down way talks about the category market size, the category penetration, the online market share, because end of the day, it is a platform which is now moving into an omni-channel business. From a bottom-up, then there are multiple numbers to focus on in order to keep it simple. We always look at number of transacting or active users, average order value, and number of orders. That kind of gives you the end of the day, the growth rate that you're talking about the business. Very quickly to go into the evolution, 2012, the company started, 2021, it has gone into an IPO. COVID was one of the big beneficiaries of COVID, not surprising because consumers moving into an online way in a much more aggressive manner, and them solving the lack of trust from a category perspective. So the timeline talks through how the funding has been raised. It's been one of the companies which has raised the least amount of capital in the so-called e-commerce tech companies, which I would not like to bucket into one, because each category is different. Each company which is solving a problem in that category is different. But because everyone wants to call this tech and e-commerce, let's just put that under the same bucket for now. Right. So from the capital raising perspective, they have raised the least capital. And it shows because the promoter still holds almost a controlling stake in the company even today, which is very different from some of the other companies that we are seeing list in the market. So what exactly is the total addressable market, the TAM as people call it? So BPC is the main category. Fashion is what I call an ancillary category, which I don't think is where the value unlocking or the value generation over the next 5 years is going to come from. I personally think that BPC is where it's going to come from, but fashion is a space they are entering into as well today in an aggressive way, right? So as you can see on the left, right? So 2017 to 2021, the online penetration has compounded significantly, 2% to 8% in India. The GMV has also grown, which is the gross merchandise value on the platform. So the TAM has grown, though the TAM is dropped in the BPC segment in the last 1 year, but at a 4-year level, the TAM has grown aggressively. So this basically talks about the combined segment, which is where Nykaa is today, BPC, which includes B2C and B2B. Nykaa is entering the B2B only today, which is where I think there is a significant upside in terms of where value is going to get generated. Fashion is space that they are entering. There is no company which has cracked the fashion model, because it's a lot more complex model, because trends keep changing on a 6 monthly basis. So pretty much Companies have come and gone, but no one has really been a market leader in this space, right? What is interesting from our perspective is some of the trends that have happened, right? Tier 2 and tier 3 cities, which most of India used to say cannot spend, it doesn't show that they cannot spend. They are spending in an aggressive way. The contribution from tier 2 and tier 3 cities for a company like Nykaa is aggressively increasing, right? And also, what you really want to be doing, I think, if you study the Amazon model, one of the reasons Amazon is the float that they built through the Prime subscription. If you read some of the Amazon letters from 2006, Jeff Bezos got the most amount of slack when he implemented Prime. When he said basically I will do free shipping, when he implemented Prime, he got the most slack. But what he was actually doing was he was building float. He was making the end customer pay upfront for a service that they would avail or they would never avail over the next few years. So tracking the preview members, which is basically paying up for usage of certain access features that you get, is also important according to us. You also have a business model where there is a strong contribution of prepaid members, as a result of which your working capital is going to be managed more efficiently. So even though you are a retail brand, you can function, you can scale aggressively with low operating leverage as well as clean debt. Again, some characteristics that one can pick up from Avenue Supermarts. Not a like for like business, but these are trends that you can pick up from company A to company B around how they scale and when they scale. What has happened in the last few years, right? Average order value. So you really want your company to keep increasing your average order value. What that means, you come into a platform as a user, you spend 1,000 rupees today. 2 years down the line, I want to be spending 2,000 rupees, not 800 rupees. If I do the latter, I have a problem, right? That means I'm not able to make a customer spend as my stickiness of that customer increases. The number of orders needs to increase, and that's again done well. The frequency of an order has been static at around 3.2 per year. That means every customer is roughly placing between 3 and 4 orders per year. As a business owner, you want to increase that as well. Right? One question that I often get asked is what happens to competition? See, end of the day, I think one needs to realize competition will be there. When someone like, there have been a few private equity players who have been on the right side of this investment. The next set of private equity players now say, I want to invest in the next company that is doing something similar. I think Purple and MyGlam are doing something very, very different. They don't have the stickiness, at least today, that Nykaa has. There is a reason that brands exclusively work with Nykaa because they want access to the Indian consumer. So at the moment, it shows from the Purple and MyGlam being at 1/10 the numbers and metrics of Nykaa as we speak. So while we will monitor this, I don't think that's the risk. The risk is of purely execution. It is an omni-channel format company, right? They have 3 kinds of retail stores: loops, on-trends, and kiosks. Kiosks are mostly small pop-up stores, as you call it, in the malls. And from a store economics perspective, right, this is again something that we want to be monitoring. At a per store unit economics model, are they profitable or not? Where is the spend going to? If it is going towards marketing, how many years does it take to break even, right? So while you can see the PAT per store is negative today, it is on an increasing trend. So what you want to be doing is, at scale, all of these retail models will work as long as your gross margins are above 50 to 55%. And that is what is unique about Nykaa, because it has significant gross margins. And you want to be turning inventories much faster. So the investment piece, what I walked you through is what are the trends that we monitor and why these trends are important for us. Now, obviously, all of this is already baked into the price. It is expensive. There's no doubt about that, right? But end of the day, when you want to buy a high growth business, the question is, where do you want to pay up and where don't you want to pay up? This is a business that we want to be paying up, consciously being aware that there could be downside along the way, right? B2B is a category that we are monitoring. It's a very nascent business. It's a big market. We think that over the next 4 years, this could turn out to be roughly between a 3,000 to 4,000 crore top line for the business, which today the business is generating around 2,500 crores, just to put it in perspective. It has the potential to grow to a 10,000 crore plus brand over the next 4 years, along with margin expansion and operational leverage. You're basically looking at all the categories put together, generating a $2 billion top line. What that means in terms of valuation, that the market will give. For us, what we care about is, are we getting growth through the business or not, right? And I think we are looking at a brand which can compound at 20% from a shareholder IRR perspective over the next 4 years. And as a result of which, we want to be participating in this growth story. What we would do in order to limit the downside is how we position size as investment. Having walked through what we bought and what we sold, now I just want to go over the entire portfolio earnings quality. How does it look today as we speak? Why does it matter? Because an investor looking at us should care about this, should care about what is not doing well in his portfolio and what is doing well in his or her portfolio, right? Here, consciously and deliberately, what we've done as a team is to give you the two-year CAGR of cash flow growth, right? It's very easy to show you the 1-year CAGR and tell you it is an abnormally high number, but that's not the way I would want to look at it, because 1 year is looking at a depressed base. So 1 year will look abnormally high. I don't want anyone to look at that and say everything is hunky-dory. 2 year is basically talking about September 21 to September 19. September 19 was pre-COVID, when things were, we were looking at a normalized phase of earnings across sectors and industries. So when I look at 2 years, we're still growing at a healthy number in terms of cash flow growth. Over the same period, revenue growth, which is the top line growth of the company, has been at around 10.5%. So our portfolio companies have come out much stronger and much better in terms of market share and earnings and revenue growth at a top line level. We've already gone way above COVID, right? So that's again a good sign. Third thing, pricing power of a business is measured according to us through gross profit margins. The higher the gross profit margin numbers, you have the ability to spend on sales and marketing for future growth. So as long as that increases, we are on a good trend. We'd spoken about this in our annual letter. I don't know how many people got a chance to read the annual letter, but if you haven't, no problem. I'll just walk you through some of the trends that we own and why we are optimistic on these trends, and how can an investor easily monitor these trends from a very, what I would call macro perspective without doing much work, right? So one trend that we own is private sector banks, right? Many people have asked, so it's a very interesting thing. 2021, Jan to December, what has been the biggest underperformer in our portfolio? It's not ITC, which is the most laughed about stock in the market. It's HDFC Bank. Why do we still own it? Obviously, there are problems in the bank. There's a transition going on. There is tech glitches. Every one of us on this call, I would imagine, has a current account or a savings account with HDFC Bank, and you've been tearing your hair around dealing with them. It's not been easy, but they are going through a transition. Through all of this, simple way, I think for a bank, if I was to think about financials, I think about the asset side and I think about the liability side. The asset side for me effectively has to do with the cost of capital. How do I acquire cheap cost of capital, as a result of which I can grow my liability side? How do I acquire cheap cost of capital? There is none other than HDFC Bank. Today, ICICI Bank is also in that space doing it well, and we own both. It's one of the reasons, and I'll come to it, why we don't own any NBFC in our portfolio, and I don't expect that to change. But on the liability side, how do I monitor my credit growth? So I want credit growth to pick up, and I want my cost of capital on the asset side to keep dropping, which basically means I'm paying out lower in FDs. So end of the day, monitoring the debit cards in issuances, though debit cards are passe maybe for most people, but debit card effectively means you are effectively opening up more retail accounts. So versus the rest of the industry, as you can see, HDFC Bank still is a leader. That's on the asset side. On the liability side, we talk about where is the credit growth coming from, which are the sectors where credit growth is coming from, and lending growth is picking up in India after a long time over the last 3 to 5 years, which is where you've seen financials actually underperforming. Why don't we own NBFCs? Just to spend 2 minutes on it. I think the fintechs coming over and taking over is not a disruption for banks. I think it could be a big disruptor for NBFCs, because I don't think fintechs will disrupt banks. I think fintechs will coexist with banks, giving them better penetration and better distribution. And what was that? Who took up that market share? According to me, it was NBFCs. So many of the smaller NBFCs, I think, will have scale-up issues. And along with the fact that they don't have a cost of capital advantage, I think the growth could stagnate. End of the day, I think we want to be owning businesses which gain market share rather than stagnate in growth. Second is the financialization theme that I've been speaking to you about. I think it's very clear today that India is going through the early stages of financialization, be it in terms of brokerage accounts opening where what you can see the number of retail accounts getting open on Demat, or the inflows that are coming into mutual funds or ETFs, we're only getting started. I think this theme is here to stay. There are going to be beneficiaries in businesses where there is zero or pretty much very little competition. And these businesses are businesses that you would want to own in your portfolio for a longer term. They're because of it being in the capital markets, you are going to see volatility, which is going to be a part of it. But as long as cash flow growth keeps compounding, this will generate shareholder return. The third theme that I keep talking about is IT or IT services. I think it's a structural theme, be it in the form of new age tech or platforms that we own, or old age. They're no longer old age, but companies like L&T Technology Services or Infosys, which we owned in some of our older portfolios. I think it's a good trend to monitor IT sector hiring. Two trends that are picking up: wage inflation that is happening in the IT sector in a very aggressive way, along with the growth of actual number of employees that are getting hired on the ground, right? Monitoring this trend is also a good proxy to understand, is this trend cyclical or structural? In the next decade, India, I think one thing that I have been consistently talking about is over the next 10 years, India is going to outperform pretty much every global market. India is going to give we are going into one of the better bull runs that I expect in India over the next 10 years. Where, like I said in the earlier part of the call, doesn't mean if we go into a bull run, we will not see volatility. I think volatility is part and parcel of the markets. The question is, how do you manage that downside and participate and increase your longevity in the markets, which is what has been the biggest concern for most investors, right? People come in 1 year, 2 year, 3 year, but how do you take them from 3 years to 10 years? And that's what we want to be doing in our portfolio. Not coming out and saying we are the best return fund on a month basis or a quarter basis or a year basis. That's never been our aim, because end of the day, it's our money also in the fund at every employee level and every partner level. So I think 5 forces in India coming together for the first time: 3 from the supply side, 2 from the demand side, which is the reason I'm extremely optimistic in India. One is being talked about. I just highlight it very quickly. We are at a decadal low in terms of interest rates. This has implications around how we save as a country and how we save globally. Yes, we'll keep talking about US increasing its rates. That noise will continue. It will pick up in 2022. But end of the day, from a company perspective, the cost of capital is low to borrow for me for the first time. Corporate India is delevered for the I haven't seen corporate India's balance sheet across sectors this delevered in the last 20 years, right? What this means is it gives private capex to get set up by actually borrowing. Now, effectively, what this means is demand can take longer than expected because I have staying power in the game. When I have debt already and I borrow more, I don't have staying power in my game. Today, I have staying power from a corporate India perspective, right? This is happening for the first time in the last 20 years. Private capex, which is what matters to us, right? While public capex is good from a growth perspective or from a stability, setting the base perspective, what I care about is private capex. Private capex has grown 12% over the last 2 years. Why don't I use 1 year? Because 1 year is a low base. So what that means is we are already spending from a capex perspective much higher than pre-COVID levels, right? All of this is from the supply side. Supply side basically means from company spending, from infrastructure spending, from, let's say, cost of capital coming down. Now, this has to compound on the demand side. There's no point of setting up supply if I don't get demand. Now, what are those 2 levers that are helping us on the demand side today? End of the day, for a country to grow, I'm not talking about politics. That's separate. That's not under our control. What I'm talking about is you need good infrastructure. You look at US's growth story 30 years back, you look at China's growth story 15 years back, it came about because of good infrastructure being set up. And that we are seeing for the first time in the last 3-4 years. And I think that will take shape, be it in the form of roads or in the form of the infrastructure corridors that are getting set up, or in the form of better transportation, GST normalizing things on the transportation side. I think improvement is across the board. Lastly, from a demand perspective, consumers need to spend. You are basically seeing startups actually not creating paper money. They are creating real money on the ground. One of the things that I spoke to you about is 2020, $38 million of ESOPs was monetized, which means this money that is getting generated on the ground by the new gen India between 25 and 45. Today, that number was in 2021, that number is around $450 million. And I think that will compound, right? You're seeing VCs aggressively spend, you're seeing private equity aggressively invest. All of this, yes, capital comes at a cost. There is going to be ramifications of all of this, but as long this is what it takes to grow, right? So there is a demand side also coming in order to support the supply side. And I think all of these trends coming together makes us confident that the next decade will continue to belong to India. And the way we participate through that is to invest in good cash flow growth oriented companies, because that is a tried and tested way in order to compound capital. And that's what we follow at Itus. Final thoughts before I end this presentation and open the floor. I think it's very clear the environment from an equity perspective is extremely conducive for a bottom-up stock picking. I highlight bottom-up stock picking. The fundamental shape of our portfolio is robust. What do I call as robust? I measure it quantitatively through cash flow growth. I continue to believe that India is the best geography from a risk deployment today. Public market is primed to be the best risk-adjusted return asset class. And investing in growth will continue to provide significant opportunities for us as we build or ramp up portfolios. So I'm going to finish the call with this and open the floor to any questions that may come.
Thank you, Naveen, for the update. I request investors and participants to type in your questions using the chat button. The identity of investors are protected as the questions are visible only to the panelists. Naveen, I have a question. So with low interest rates and corporate India delevered, you see private capex and public capex increasing. Do you think it's a good time to invest now or wait till the budgets?
So, I mean, I don't know about the budget is really done, right? I think the government has already made it clear, right from the PLI schemes that they have set up, and multiple industries have benefited as a result of on-the-ground manufacturing. I think even if they do nothing in the budget, be it in the form of helping in the form of, let's say, income tax or cutting STT, or let's, for example, say lowering long-term capital gains, I think as long as they do what they said they would do, I think we are on a good path. What does retail India or institutional India expect from the government is consistency, right? Not changing track every 1 year, saying that I will do this year, I will do this next year, right? As long as there is consistency, I think we are on a smooth track. Private capex is what will drive growth, right? So will budget give volatility? I mean, to be honest, it doesn't matter beyond the point, is my view. Now, to answer your question around should investors invest today? So I think end of the day, if an investor wants returns every quarter or every 6 months, they can look at timing the market. I'm not sure how you can time the market. I think volatility is here to stay in 2022. 2021, investors have seen a very smooth ride. As long as you prime for volatility and you invest in those kind of companies which are growing their cash flows, I still think it makes sense to invest, whether you're doing it yourself or investing in Itus or any other fund that you pick. Invest with a philosophy in mind around why you invest rather than worrying about what the market does. Because end of the day, you are investing in companies, not the market.
Right. Thanks, Naveen. Another question. Do you see ITC will keep generating cash flows? Then cash price should show its impact?
So Since it's a company specific question, we used to own ITC. For most part, we are out, right? We've been trimming it down as I've spoken about. And I think cash flows from ITC will come through, right? That's never been a question. There are 3 core businesses and there's a 4th private company that ITC owns that no one talks about, which should get unlocked through a demerger. But then the question is, how will they demerge and when will they demerge? Because no one is showing intent to demerge. Right, so you have the hotels business, which is a cash guzzler. You have the FMCG business, which is actually growing its cash flows and it's turned EBITDA positive for the, let's say, over the last 3 quarters for the first time in the last 5 years. And then you have the cash cow, which is the core cigarettes business, right? So ITC, the problem has never been cash flow growth. The problem has been value unlocking because the cash flow growth has been reinvested in the wrong places where they've been growing the hotels business aggressively. The last 1.5 years, they said they would stop doing that and focus on the FMCG business. Now that is showing some amount of growth. But end of the day, this has to be a constant endeavor. Then there is a core value that needs to be unlocked from the IT services business, right? ITC has a company called ITC Infotech that no one even is aware of, right? But end of the day, so I think over the last maybe 3 months, the management did a call with all the retail investors. They did a 238-page presentation explaining what they are going to do. It requires a 2-page presentation to explain what they need to do. You don't need 238 pages. When a management explains what it's going to do over 238 pages, I get worried, right? What they are telling, and it was a 7-hour call. I don't know how many investors attended the call because many of them are shareholders of ITC. They did a 7-hour call to explain. You need 15 minutes to explain what you need to do and do what you say you're going to do. So unfortunately, you have a great business, a brilliant cash generating machine, which has been reinvesting in the wrong places. Now there is a value unlocking potential, but I don't know who's incentivized to unlock the value. I always say this: you show me the incentives, I'll show you the end result. The incentives are not aligned, right? So I'm not certain who's going to get incentivized by unlocking the thing. So those are my concerns. It's never been the cash flow generation that's been a problem with ITC.
Another question. With respect to IT and IT services, the valuations are high. Will the money deployed there for new investors in others, with new investors in this sector, for them too? Will you invest in the IT?
Repeat that question.
Will you invest in IT and IT services for new investors as the valuations are high?
So I always urge investors to think about growth first, business model second, and valuation third, right? So the reason I urge investors to think about it this way is the moment you bring valuation as your first priority for decision making, you will not participate in growth businesses. Some of the aspects of why I wanted to highlight cash flow growth in the earlier part of the conversation was when there is cash flow growth, you're not going to get valuations cheap unless and until you get a COVID again or a GFC again, which might happen once in 10 years, right? So I can't wait to get such an environment. I need to invest for growth. So what I'm getting to is we will invest in IT and IT services, but the allocation will be lower today versus an investor who's been with us, let's say for the last 2 years, who's seen a significant growth in that bucket of our portfolio. So what we do is manage risk from 2 buckets. One, you want exposures in high growth companies. You manage those exposures through position sizing in an appropriate way. As a result of which, we don't believe in what the industry follows called model portfolios. So I hope I answered that question, Ajit.
Yeah, okay. There's another question saying that some of the pharma companies have fallen 40% from the top. Is there any major change in the business model?
So there is no change in the business model, right? Pharma companies, and again, pharma is a very, very broad sector, right? You have US facing pharma companies which are going through significant headwinds today because you have completely lost out on the pricing. There is significant pricing pressure because most of the distributors and hospitals have already stacked up aggressive inventory over the last 1 year. as a result of which demand has fallen, which has affected prices. You have the Indian side of the businesses, which are more so branded companies, which are growing at almost 30 to 35% CAGR. So it really depends. If someone is saying that pharma companies have fallen 40%, my first reaction would be they should be mostly portfolios with a lot of US exposure. And I think those headwinds are there for the next few quarters. Right. So pharma needs to get isolated into the business model. It's a very unique sector where I always have said consistently the large cap pharma companies are more riskier than the mid and small cap pharma companies. It's counterintuitive, but that's what it is. Because the way you become a large cap pharma company is by getting scale and going to the US. And once you go into the US, you become a commodity company where you are a price taker rather than a price giver. Right. So it's important that you distinguish between the two. If it is an India specific pharma company which has a manufacturing entity on the ground, then you would see better, you would not see this kind of volatility.
Thank you, Naveen. Naveen, the next question is about Nykaa. So Nykaa currently commands disproportionate valuations on the back of strong liquidity. So is it worth to take the risk paying 30 times PS where do you see margin of safety there?
See, end of the day, margin of safety comes from the future, not today. So when you look at Nykaa today, valuation, like I already made a comment that valuation is not cheap. So do I expect, can Nykaa fall 30% in the next 2 years? It certainly can. Right. I don't know the path to the compounding. But what I do know is it has a very sound business where I can see that over the next 4 years, if they execute right, the 3,000 crore top line can grow to a 14,000 to 15,000 crore top line. Right. So how do I manage the downside? By controlling my exposure. So for us, as long as the fundamental cash flow growth comes through, as long as fundamentally the business is growing in a platform where there is good trends that we are monitoring, we would want to be owning the business. We would want to take an exposure. How do I ensure I manage the downside? Is through position sizing.
Got it. Next question about is with 5G coming, do you look to invest in the telecom sector? For every you have all your smart meters going with SIM and data connections increasing.
So I think lot of investors, a lot of questions around looking at things from a top-down perspective is not generally how we like to invest. For us, it is extremely bottom-up. As the telecom sector evolves, right? For example, as India moves from 4G to 5G, which we will over time. For me, the fundamental question is, telecom today is a 3-player game. Some people might say even a 2-player game, right? Because of the third company going through the problems that it has and lost customers along the way. So it has great dynamics from a competitive landscape perspective, but you don't have pricing power. Your pricing power is dependent on the largest incumbent who sets the price. Second, you need to continuously keep investing in CapEx for you to survive. 4G to 5G will happen, which means both the companies has to reinvest into CapEx. It's not like my existing CapEx will help me transition from 4G to 5G. As a result of which, companies that need to keep reinvesting in order to just exist are not great cash flow growth companies for us. Is value there in some of these companies? For sure. Does it fit into our philosophy? If from a company's perspective, company-specific perspective, it does, we would look at it. Today, do we own any company in the telecom space? We don't. The reasons being what I just highlighted.
Sure, thank you. I mean, IEX has done well over the last 2 years. So what is your expectation going forward? And what is your expectation of the energy sector in general?
So let's let's just quantify what well means and what is actually happening with regard to the broad trends and the competitive landscape, right? So in the energy sector, see, 5 years back, power in India was predominantly priced as 30-year long-term PPA contracts. When IEX was set up 12 years back, the aim was to always basically say companies should be able to manage their short-term power and energy requirements through the exchange rather than setting 30-year price contracts, because I really don't know and I don't have the ability to predict my demand and supply cycle over 30 years, which led to bankruptcies across the board, right? So there was a need for an exchange to come in. The regulatory environment slowly started providing tailwinds to the exchange, where discoms started coming in, companies started coming in, there was more transactions. And COVID provided the biggest tailwind as far as I'm concerned, where people started moving significantly to short-term energy trading on the exchange. Today, 6.5% of the total power is transacted in India on the exchange. What was it 2 years back? It was 3%. So what you're saying is you have doubling of the market size in the next, you've had doubling of the market size in the last 2 years. Can this grow to 12% or 10%? The answer is yes. Who is primed to benefit out of it? As we speak, IEX. Has the competitive landscape changed? Of course, right? Because as you see one player making significant amount of cash flow growth, and revenue growth, because the return on capital of IEX is 74% today. It's unheard of, right? So you will have other players getting regulatory approval to set up, but it takes time to come and scale. If NSE says I want to set up power, it's not like tomorrow they can switch on a machine and then say let's trade, right? There is a lot of IP behind this. There is a lot of investments in technology behind this. So the competitive landscape really is not the concern. The concern could be, will the government come and say you're charging too much from a contract perspective? It could happen, right? So there are two aspects to IEX today. From a growth perspective, I think there is significant growth behind it. Are there risks? Like in any business, there are. So we would monitor both as we price. So if you ask me, IEX still has potential tailwinds behind it, but there are risks in the business as well, because one needs to understand that the price per contract IEX charges today is significantly higher than global standards.
Thanks. Naveen, for a new investor, how would you deploy capital at this point? Is it right time to deploy funds or need to wait with the intention to invest for a long term?
See, for us, we are not looking at timing the market. We are looking at managing risk on the downside. So if a new investor comes today, I would expect almost 70% of the capital to get deployed over the next few weeks. And we would be selective in terms of ramping up exposure into some of the stocks, right? It's not basically saying, like I said, someone earlier asked the question, how are you looking at tech? I'm not looking at timing tech, or I don't know how to time tech. And no one knows how to time. It's not the point. The point is to basically say, how do I take exposure into growth companies and size your exposure right over time, right? I'm not looking to time Nika. I want exposure into growth. And maybe the path to that is not smooth. But in order to control the downside of that path, you position size your exposure accordingly. So rather than thinking about it in the form of saying, is it the right time to invest? The question is, what kind of capital do you have versus what kind of capital do you want to invest? What that means is, if you have 100 rupees of capital to invest, maybe you should think of deploying 60-65 rupees and then looking at slowly getting into the market, rather than saying, can I do it today, or can I do it 2 months down the line, or when is volatility going to come? Because those are moot questions. The process is more so important than the timing. That is the biggest takeaway that I would want every investor to take home, right? Because timing is not, there has not been a single investor who's done it right. So if someone says that they can do it right, they are fighting odds against it. much rather take control of the process, which helps you compound with the benefit of time.
Can you share details about cash flows in Nika?
Sorry?
Can you share details about the cash flows of Nika?
Sure. If whoever has the question can send an email, we can share that.
Sure, done. And Naveen, your plan on Bajaj Consumer and the thesis for being in the portfolio?
So it's a very small exposure, right? It is a recovery story. Again, cash flow growth has been around 18% compounded. The problem has been reinvestment. If they don't get that right, we will exit. It's a very small position in certain portfolios, and we might exit even if it is at a loss.
Naveen, the last question. Do you plan to invest in international markets?
No, not at the moment, and not anytime soon. I think it's extremely important to realize there is a reason why we invest in India sitting in India. Right? I think if someone can tell me that they can sit in India and have a view on China, I would say good luck, right? Because having worked 11 years in Hong Kong, I can safely tell you I don't understand China. One of the first prerequisites to understanding China is you need to learn Chinese and read balance sheets in Chinese, because a lot of balance sheets are in Chinese. Right? So if people are investing in Facebook, Amazon, Google, sure, they should, they can. Right? But if people are investing in bottom-up companies along the way, I think it makes sense to sit in that geography and invest. I cannot tell you that I'm extremely bullish in India and say I run an international fund. It doesn't make sense. Right? I always tell people, don't look at what people say, look at what they do. Right? I cannot tell people that I am bullish in India, I have all our money in the fund in India, and say we do international equities. It doesn't go hand in hand. So no, we won't.
Sure, Naveen. Naveen, those are about the questions. Thank you for it. Maggie, you can take.
Yeah. Thank you, Naveen and Ajit, for all the updates. At this time, I'd like to thank all the participants for your patience on the call. So the recording of this webinar will be sent out once it's made available. Thank you all and have a wonderful weekend.
Thank you so much to everyone again.